Accounting and finance, two of the most important disciplines that dictate the success of a global business strategy, regardless of the size of the company. Accounting is the language of the business and expressed in financial statements, which are historical in nature. With these various financial statements, a global company is able to communicate its financial position to many different stakeholders, whom will be able to access its financial health. A robust accounting system is critical to the smooth operation of a global business. However, there is one glaring problem with accounting in a company with global operations: the lack of consistency in accounting standards among the more than 200 countries in the world. Financial management looks at three different decision areas of a global company, and domestic as well. 1. Investment decisions. 2. Financing decisions. 3. Money management decisions. Financial management considers all three when deciding which activities need to be financed, how best to finance those activities, how best to manage the financial resources, and how best to protect the global business from political and economic risks, including foreign exchange. Global business is challenging enough, but to add an additional level of complexity in the form of accounting standards differences makes one not want to expand globally. There are two areas to consider in accounting: accounting standards, which defines what is useful accounting information, and the rules for preparing financial statements, and the auditing standards, which specifies for performing an audit of financial statements. National differences in accounting and auditing standards can make it difficult to compare financial reports from one country to another. Why is this important? Global providers of capital are demanding consistency in reporting of financial results, and the adoption of common accounting standards will facilitate the development of the global capital markets. There are two major accounting standards in the world. The one used by the majority of the world falls under the control of the International Accounting Standards Board. This board is responsible for developing the international financial reporting standards. While the majority of the world has accepted the IASB as the effective voice for defining accepted worldwide accounting principles, one country has not recognized it: the United States. One of the reasons why IASB standards have not been accepted in the U.S. is because the majority of the IASB standards are consistent with standards already issued by FASB. GAAP, which is governed by FASB, dictates the manner of preparation of U.S. financial statements. The IASB and the FASB have a common goal of converging the two standards into one. However, there remains an impasse on how to accomplish this goal. One way would be for the United States Securities and Exchange Commission to allow U.S. publicly traded companies to use IFRS prepared financial statements rather than GAAP prepared financial statements when reporting their results. This action would lead to the end of GAAP. First, there is no global financial management board. However, financial management will be dictated by the accounting standard a company uses. There are three key components of global financial management, which also applies to a domestic company as well: investment analysis, financial analysis, and money management. Capital budgeting is one of the most important tools used in financial management. It allows the global finance leader or manager to quantify the benefits, the cost, the risk of an investment, and to compare different investment alternatives within and across countries. The capital budgeting process includes an estimation of the cash flows associated with the project over time, must be discounted to determine their net present value using an appropriate discount rate, and a decision as whether the investment should go forward. This process is the same whether it is an investment of a domestic or global project. However, for the global project, there would be a need to adjust the analysis based on the political and economic risks previously covered. The most effective manner in which to address these adjustments for the increased level of risk is to treat all risk as a single problem by increasing the discount rate applicable to foreign projects in countries where political and economic risks are perceived high. Once an investment decision is made, the next step is to determine the best method for financing it. In many instances, these investments will be financed through internally generated cash flows of the parent company or the foreign company operations. However, there will be other times when financing will be needed, and determining the best source of capital funding will become an important decision. Money management in a global business can be used to minimize cash balances, transaction costs, and taxation. One of the most important global money management responsibilities is managing the global tax burden. Double taxation occurs when the income of a foreign subsidiary is taxed both by the host country government and the parent company's home government. In 2018, the U.S. government lowered the tax rate on repatriated cash from 35% to 15%. During that year, over $660 billion was repatriated to the United States. However, it is estimated that U.S. companies still have anywhere between $1.5 to $2.5 trillion in overseas accounts. For the finance leader or manager who is supporting a business strategy to grow globally, it is imperative that the person or organization clearly understands how accounting decisions, investment decisions, financing decisions, and money management decisions are complicated by different currencies, different tax regimes, different levels of political and economic risk, and so on. For those same companies, global businesses are confronted with a number of accounting challenges that do not arise in the case of a domestic business. They must prepare reports for international constituencies and translate and consolidate information across countries and currencies. Financial managers must also account for all of these factors when deciding which activities to finance, how best to finance those activities, how best to manage the firm's financial resources, and how best to protect the firm from political and economic risk, including foreign exchange risk. Good financial management can be a source of a competitive advantage because it can lower the cost of activities and enhance the value of activities of the firm.